Добрый день. Скажите, пожалуйста, меня слышно? Кто-то ответьте, пожалуйста, голосом, потому что я здесь вас не слышу. Вы отвечаете голосом?
Да, вас слышно.
Вот, хорошо, спасибо, вас тоже слышно. Преподаватель опаздывает, чуть будет позже, я тогда оставлю конференцию. Как он подойдет, вы его увидите.
А есть примерное ожидание по времени, когда преподаватель начнет?
Ну вот занятие 6:30, его пока нет, он не подошел. Но он будет, я с ним была на связи.
Спасибо.
Guys, sorry for being late. 5 minutes and we start.
Уважаемые студенты, скажите, пожалуйста, есть ли вообще желающие приходить в аудиторию, поскольку у нас очные занятия все-таки заявлено, и кто-то голосовал, что будет приходить, но в аудитории никого нет. Нам целесообразно приглашать преподавателей в аудиторию? Все молчат. Хорошо, я тогда напишу еще раз, сделаю опрос по почте, разошлю и буду надеяться на ваши ответы. Мы приносим свои извинения за сложившуюся ситуацию. Интересно, они меня слышали?
Нет, да.
Мне кажется, они что-то до этого обсуждали.
А где пульт у вас от кондиционера сейчас, Ульяна? Вот так? Давайте его включим. Я снова выключу.
Ну, просто не понимаю.
Да? Ну, сейчас очень даже нужно. So let's start. Once again, sorry for being late. So last time we talked about Russian local debt market. We discussed the OFZ market, and we stopped to have quiz just before the corporate section. Well, I expect that we continue this talk today, but first of all, let's start with well, theoretical part with the different approaches to credit analysis, so that we better understand what do we mean by speaking about credit spreads, their dynamics, and all things like this. So one more thing is that, well, didn't have enough time to consolidate all the quiz answers, and I will revert to you well till the next class with this. I see a request that you had some technical issues. Okay, I will think how we can resolve this. The request from Leah. So what else? Your group splits. Well, actually, this credit analysis part usually well, is somewhere close to the end of the class. But as we have well, some relatively big homework which you expected to do, your credit reports, I usually try to go through these well, chapters somewhere in the middle of the course, so that you have some understanding of how to proceed with your home tasks. Still, I haven't received all your group splits. Well, if I'm not mistaken, 27 people just sent me the group splits, and well, I believe it's just half of the group. So please hurry up, send it me till the end of the day. Otherwise, I will split you on my own decision, because I need to give you companies for you to start working with them. So, and one more thing here is that we have two lessons, well, because there are a lot of people, and we decided to split you into, well, two classes. So half of you will go through presentations one day, and half of you the next day. It will be somewhere in the middle of June. Well, I don't remember the particular dates. If I'm not mistaken, somewhere close to 16th or 17th of June. So I will provide you the company names and all the information regarding what you need to complete this credit stuff on the weekend. I believe you should start working on this. Well, this is not a very big stuff, but still you need to spend some time. Well, I expect that we have some, you sent me some drafts. The first one will be some kind of, well, a preliminary draft with the key slides which you want to use, and maybe with key, well, ideas, key bullets, what you want to put on these slides. So for me to understand the structure of your presentation, and just to give you comments on whether you addressed all the issues that I would expect you to address or not. And then we will have the final draft, like just pre-presentation draft, for me to give you the last comments and for you to be able to insert them. So this will be how we will be addressing all this credit analysis stuff. You will be doing it on your own. I will be commenting on your drafts, and we'll be commenting on your presentations, and we will have Q&As for each group after you present your company. Keep in mind that when we speak about the preliminary draft, I expect you, well, not to complete all the charts, all the text boxes, but I want you to have some kind of an understanding what you want to do. So I just don't want you to put some generic slides saying, okay, this slide will be the industry overview, and this will be the company overview. That's not the way how we want to proceed. So please just spend your first week working on this project just for examining the company. Actually, you need just not more than 1 day to do this, but okay, for you, maybe it will take more time. Just examine your company, just the key credit aspects that you want to put, and just structure the future presentation. This will be enough for your preliminary draft. But again, please don't send me some generics with no understanding of the company which you are examining. Otherwise, I will not be able to give you comment, and you will not be able to complete the credit presentation in proper form. So when we speak about the credit analysis generally, this is not like some kind of this is not like a new science. Yes, this is just a way, a framework of how you want to combine all your skills that you are expected to already possess, and how to use them to solve this problem. Actually, the key idea of the credit analysis is the corporate company analysis, and actually the key idea here is the financial statement analysis and understanding the, okay, at least not understanding, but addressing the key questions and raising key questions on the business profile of the company and how it converts to its financial profile. But so the idea here is that this approaches to credit analysis will show you how to use skills that you already possess to and how to address the problem. But this is just a framework of how to combine all this together, and which angle and which questions should be important for us when we look to the credit profile of the company. So first of all, what is a credit risk? Credit risk is actually, when speaking about fixed income instruments, we will speak. There are a lot of risks associated with them, definitely, like some kind of tax risks. I don't know, liquidity risks, regulatory risks, whatever. But we have two major components, two major risks that are important to us. These risks include the credit risk and the interest rate risk. So today we will address the credit risk. Later on, I believe we actually will be finishing our course speaking about the interest rate risk, about its components, and how we can use different investment strategies like bullet portfolios, barbell portfolios, how can we place spreads, long, short positions into different tenors, and how we can use all these strategies to operate this risk, to minimize it, and to redistribute the interest rate risk. So, but today we focus on the credit risk. Actually, I would say maybe this is not academical correct, but credit risk is more like, qualitative stuff, while the interest rate risk is more a quantitative stuff. So for credit risk, you need to do calculations, you need to calculate ratios and things like this, but mostly what you need to do is to understand how the company operates, how the industry operates, how its operational performance translates into financial performance, and whether the company will be able to pay its debt or not. So the credit risk. This is the risk which is associated with the losses stemming from the failure of a borrower to make timely and full payments of interest and principal. And credit risk has two major components. First is a default risk, and the second one is loss severity, or a more known word is a loss given default. So everything is quite easy here, I believe. So the default risk is the probability that the borrower fails to pay either interest or principal when it comes due. And loss given default is the value which investor will lose if the borrower defaults in monetary or percentage amounts. So two more things to keep in mind here. We have an expected loss, and expected loss is just the result of the default risk multiplying by the loss given default. And we have a recovery rate. This is actually the percentage of bonds value an investor will receive if issuer defaults. In other words, it can be calculated as an opposite to loss severity, or in other words, loss severity is equal to 1 minus the recovery rate. So Bonds with credit risk trade at higher yields than bonds thought to be free of credit risk. And the difference in yield between a credit risky bond and the credit risk free bond of similar maturity is called the yield spread. So the yield spread is usually calculated as a difference between, for example, some kind of a corporate bond to the yield of a corporate bond to the yield of a, for example, some kind of a benchmark bond. Usually it's a government bond in the same currency. It's important that they need to be in the same currency. Otherwise, it doesn't account for the parity. Actually, we'll speak about later on today. We have other spread measures, for example, Z spread or, I forgot the name of the spread. Sorry. Okay. Once I remember, I will revert to this. So the spread is a difference between the yield on a corporate bond and some benchmark rate. Sorry, I spread. Sure, it's I spread. It's usually a spread of bond, corporate bond, some risky bond, or it may be not corporate, but some federal bond, for example, to the swap curve. So in other words, it can be just the value of some basic rates in in different currencies. So we already mentioned, we will talk about this next time, about the approaches to bond valuation, and we will see in different calculations that bond prices that bond prices are inversely related to bond yields, but the same is true to yield spreads. I mean that bond prices are inversely related to yield spreads. So a wider spread implies a lower bond price, and while a narrower spread implies a higher price. And the size of the spread reflects creditworthiness of the issuer. And actually, it's always a question. Different studies show different approaches to this. Well, for example, in CFA stuff, and for example, again, you look into Fabozzi books, which are the most popular in the bond market, you will see that they incorporate into this yield spread relation not only the credit premium, but also the liquidity premium and liquidity premium. Some studies include here only corporate premium, and they will account for liquidity premium differently. Some incorporate some maybe tax premiums and things like this. So it's just a way of different approaches, but overall, I believe it's quite reasonable to speak about at least liquidity premium when we speak about the spreads. So spread risk is the possibility that a bond spread will widen due to one or both of two factors. The first one is the downgrade risk. It is the possibility that spreads will increase because the issuer has become less creditworthy. So when we say creditworthy, we mean that either the company, for example, our expectations, better to say, of the company financials, they deteriorate, or for example, we expect a credit rating downgrade or something like this. And the second component here is this market liquidity risk. It is the risk of receiving less than market value when selling a bond, and this is usually reflected in the size of the bid-ask spreads. Remember, we mentioned this when we talked about the secondary markets. So the liquidity is the difference. Actually, it could be measured as a difference between bid-ask spreads, meaning what is the difference between the price or yield, which is on the side of the buyers and the side of the sellers. As I already mentioned in previous classes, the bond market, for example, some corporate Eurobond, Russian market, the normal bid-ask spread is somewhere close to 5, 10, 15 basis points, while some liquid issues could have, 50 to 100 basis points on bid-ask spread, and this means that you have, well, quite a big potential losses stemming from if you need to, for example, liquidate your position immediately. You will just spend a lot of money, burn a lot of money on these bid-ask spreads. So now about different seniority rankings. We already mentioned this in our first class, if I'm not mistaken, when we talked about the structural and the contractual subordination. So here this is the contractual subordination again. So each category of debt from the same issuer is usually ranked according to a priority of claims should the event of default happen. This bond's priority of claims to the issuer's assets and cash flows is usually referred as seniority rankings. That can be either secured or unsecured. And also the debt could be senior or junior. So the secured debt, as it follows from the name, is backed by some kind of collateral, while the unsecured debt represent a general claim to the issuer's assets and cash flows. By definition, the secured debt has a higher priority of claims than unsecured debt should the event of default occur. So the secured debt can be further distinguished as, for example, first lien debt, some senior secured, some junior secured, and so on, so on. You can see it in the chart on the slide. The unsecured debt can be divided into senior, junior, and subordinated gradations. The highest rank of unsecured debt is senior unsecured, while subordinated debt ranks below other unsecured debt. What is important here is that all debt within the same category is set to rank pari passu or have same priority of claims. So all senior secured debt bondholders or just lenders are treated alike in a corporate bankruptcy. Well, essentially that recovery rates are highest for debt with the highest priority of claims, and recovery rates decrease with each lower rank of seniority. The lower the seniority ranking of a bond, the higher its credit risk. And well, the conclusion here is that investors usually require a higher yield, actually not usually, but always should require a high yield to accept a lower seniority rank. So in the event of default, as stipulated by the scheme on the slide, senior lenders have claims on the assets before junior lenders and, well, equity holders. But an important thing here is that in practice, this strict priority of claims is not always applied. Well, by law and, well, theoretically, in theory, the priority of claims is absolute, but in reality and in practice, there are a lot of cases when lower priority debt holders may get paid even before the senior debt holders, or at least before senior debt holders are not paid in full. Why this could happen? This could happen because, well, bankruptcies are usually costly and take a long time to settle. During bankruptcy proceedings, the value of company's assets could deteriorate due to loss of customers, key employees, while legal expenses mount. Bankruptcy reorganization plan is confirmed by a vote among all classes of investors with less than 100% recovery rate. To avoid unnecessary delays, negotiation and compromise among various claim holders may result in a reorganization plan that doesn't strictly conform to the original priority of claims. And this is important because in reality, when the company has problems with paying its debt, well, in rare cases, it goes under the bankruptcy. In major cases, it starts the process of reorganization of its debt. And there are a lot of cases when, well, the priority of claims on different debt can be changed so that, well, senior debt holders will be effectively no more senior debt holders, and whatever. Definitely, this will all require the approval of creditors. But well, my real life example, and especially when there were a lot of cases, and after the Ukraine crisis, the East Ukraine crisis, there were some companies like Metinvest, Detect, and some other companies that went through the reorganization. And well, there were a lot of different cases and a lot of different situations when the, well, post-restructuring priority of claims changed. I'm sorry, 1 second, I need to answer a call. Just 1 minute. Sorry, let's continue. So the idea is here, for example, we had, if I'm not mistaken, it was a long time ago, actually, we have a Metinvest case. The company had some debt on the level of PXF financing, like pre-export financing, and had some Eurobonds outstanding. The Eurobonds were unsecured, while PXFs, they were secured, if I'm not mistaken. So, and the company was talking about the reorganization, and actually there were Eurobonds which were maturing, for example, I don't remember in particular, but for example, one Eurobond was maturing in 1 year, the second one was maturing in 3 years, and the third one was maturing in 7 years. And the company was trying to, for example, to issue a new Eurobond and to switch all the holders of 3 different Eurobonds into the one bond, which, for example, matured in 10 years. So on the one hand, nothing changed in terms of the seniority ranking, which we just discussed, but actually different investors were expecting to receive their money back on different time horizon. And this was quite a hard exercise. And if I'm not mistaken, the company was not successful with changing all investors into the same date. Of course, for example, it's not fair actually if you swap those investors that held the issue that was maturing in 1 year or 7 years into one and the same 10-year bond, right? There were also talks that to probably change the proportion of PXF and, well, Eurobonds, maybe to swap one into another, and this is actually how it goes. So the idea is here that should the event of default be somewhere close and the company needs to restructure its debt, it effectively will probably not go into the bankruptcy, but will go into the restructuring process, and a lot of will depend whether the company has some preliminary agreements with the key lenders, because well, to make changes to amend the current loans and the terms and conditions, you will need to receive the approval from the lenders, from banks, from bondholders, etc., etc. But probably you have some major group which agree on your terms. Then, let's say the minority holders in these debt instruments, they will be and could be discriminated. This is important to keep in mind. So now let's talk about credit ratings. So credit ratings are very important on the bond markets, and they are used as a, well, They're issued by credit rating agencies. We have three of them: S&P, Moody's, and Fitch. Well, they are private companies, so they receive actually money for rating different issuers. But their reputation is considered very high. That is why, even despite receiving money for issuing these ratings for the companies, they considered to be quite fair. For investors, in reality, these credit ratings, this is actually like a first glance approach to understand at which category, at which credit group the company you're examining is positioned. But definitely this is not enough for you to understand whether to invest into the bond or not. So this is like just a first glance approach. The ratings are also usually required by different regulations. For example, in Russia, we had requirements by central bank for issuers, for bond issuers, to have, well, at least the minimum level of credit ratings for the bonds of such issuers to be eligible for pension fund investments, for insurance companies investments, for the inclusion to the so-called Lombard list of Central Bank of Russia. This is actually the list where the central bank is ready to provide financing when such bonds serve as a collateral. A lot of things like this. I believe a lot of these regulations, they are in place in different countries, but at least a lot of different investment funds, they have again the minimum rating level requirements in order to be able to invest into the bonds of such issuers. If you remember, in the very beginning, we talked about the fact that there is a significant difference in credit ratings between the investment grade and non-investment grade, or in other words, junk of high yield bonds. You see it in the table to the in the table to the left. The break-even level is at the BBB minus from S&P and Fitch, or Baa3 from Moody's. So this is the minimum investment grade level. All the ratings that are below are considered to be low grade or speculative grade. And I told you that the assets under management of all funds that track the investment grade are significantly higher than those that track non-investment grade issuers, and there is a significant inflow or outflow when the company receives its investment grade rating, or if it loses its investment grade rating. We will speak about outflows. Credit rating agencies assign ratings to categories of bonds with similar credit risk. Rating agencies rate both the issuer and the debt issues of the issuers, or in other words, they rate the bonds. So, and these credit ratings might be different. So the issuer credit rating is usually called the corporate family rating, but well, the terminology here can differ from one rating agency to another. So, and the issuer credit rating is meant to address an obligor's overall creditworthiness, or in other words, its ability and willingness to make timely interest and principal payments on its debt. This is what about the issue rating. The issue, so each particular bond credit rating, refer to specific financial obligation of an issuer and take into consideration such factors as ranking in the capital structure or as the seniority ranking, which we discussed above. So the usual situation is that The usual situation is that the issue credit rating is equal to the issuer's credit rating, or it is lower. Still, there are situations, and well, it's quite it's possible that the credit rating of the issue of the bond issue can be higher than the issuer credit rating. So the difference between the issue rating and the issue rating is called notching. So notching is the practice by rating agencies of assigning different ratings to bonds of the same issuer. Notching is based on several factors, including seniority of the bonds and its impact on potential loss severity. An example of a factor that rating agencies consider when notching an issuer is structural subordination. For example, in a holding company structure, both the parent company and the subsidiaries may have outstanding debt. A subsidiary's debt covenants may restrict the transfer of cash or assets upstream to the parent company before the subsidiary's debt is serviced. In such a case, and remember that we discussed this case when we talked about the structural subordination again in the beginning of the course. So in such a case, even though the parent company's bonds are not junior to the subsidiary's bonds, the subsidiary's bonds have a priority claim to the subsidiary's cash flows. Thus, the parent company's bonds are effectively subordinated to the subsidiary's bonds. And this is actually why the notching can happen, and the bonds which will be issued by holding company, but not the subsidiary company, or without the guarantees from the subsidiaries, they will have notching and will receive a credit rating which is lower than the rating of the bonds issued from the level of the subsidiary, or the rating which is lower than the group's rating. It's a usual example, and we have such case, if I'm not mistaken, for example, on the Russian debt market with the, for example, with the company called Evraz, one of the largest metals and mining companies. It has assets mostly in Russia, while its group is domiciled in somewhere abroad. I forgot, maybe in Netherlands, if I'm not mistaken, or in Luxembourg. And it issues Eurobonds issued by the holding company, but if I'm not mistaken, without the guarantees from the rating companies. And that's why the company Eurobonds are rated lower, so they are notched relative to its group rating. So this is a usual situation. What else do we want to mention when we speak about credit ratings? Okay, let's talk about the risks relying on ratings from rating agencies. There are, probably 4 specific risks which we could highlight here. First, credit ratings are dynamic. What does it mean? It means that credit ratings change over time, and rating agencies may update their default risk assessment during the life of a bond. Higher credit ratings tend to be more stable than lower credit ratings. The idea here is that when you take the investment decision, you take into the consideration the ratings which the company have right now. But for example, if it is a 5 or 7 year or even 2-3 year bond, there is no guarantee that credit ratings of the company will not change when the time passes. And it might result into different outcomes. The ratings might be improved, and probably this will lead to these yield spreads decreasing, even if the benchmark rates are stable, meaning that you will receive a price appreciation and capital gain on such bonds. It can go different way, and the ratings might be decreased, and you will, or you could, at least there is a risk of receiving some capital loss on holding such a bond. In worst case, for example, you are an investment fund which has strict restrictions on an investment policy to invest only into the bonds with the ratings not lower than, for example, A- level, and if the rating of the company is downgraded to, for example, BBB category, you will be just required by your investment policy to reduce position, to cut your positions in such bonds, and you will just effectively need to to fix losses from such a position, because, well, if the ratings are downgraded, probably you will receive a negative mark-to-market valuation. So, and moreover, you will just not be able to wait until the situation improves, but you will need to cut your positions, because this is regulated by your investment policy or maybe country regulation or things like this. So all this brings its risks to relying on ratings. The second the second risk here is that rating agencies are not perfect. Surprise, surprise. And this is a well example following the crisis of 2007-2008 and the following crisis in the Eurozone. So rating mistakes occur from time to time. These subprime mortgage securities were with which we had a crisis in 2007-2008. So these subprime mortgage securities were assigned much higher ratings than they deserved. The risks here is that, well, the methodology of rating agencies is not perfect, might be not perfect. So meaning that their general approaches to the credit analysis of the framework, I would say, is not correct. Sometimes the idea that rating agencies are not perfect might be that, well, all the ratings they are they're examined by rating analysts. So the rating analyst is working on some sector in the rating agency and, well, in some region. He provides he calculates all the ratios. He's finishing quite a comprehensive study of the operational and business profile of the company, consolidates all together under the methodology, and, well, receives some rating result which he wants to assign. Then this should pass the rating committee, where a lot of different participants from different sectors and different regions take place in order to to challenge the rating analyst to understand whether the ratings which he wants to assign are assigned in line with the approved methodology, and whether they are quite, let's say, sound to what is happening around the company. But still, sometimes mistakes could occur, and everything, a human factor here is in place, even despite all these committees and things like this. So third thing is that there is an event risk, and event risk is quite difficult to assess. Risks that are specific to a company or industry are difficult to predict and incorporate into credit ratings. There could be a lot of different examples. For example, some national disasters, some acquisitions, some, for example, spin-off of assets, change in regulation, equity buybacks. So you can hardly predict this, and this could significantly affect your credit rating once it happens. Well, for example, in Russia, we had Polus case. Polus is a large gold producing, the largest gold producing company in Russia, and one of the largest in the world. So the company was public, but somewhere, if I'm not mistaken, 2015, 2016, its key shareholder decided to buy back almost all the shares from the market. The free float remained quite insignificant, and this actually, he used a lot of debt to finance this, and there were several consequences. First, the company stopped to be public, and this could lead to less transparent financial policy and financial disclosure. Second, in order to complete this buyback, he, on the shareholder level, he attracted a lot of debt financing, and this meant that this resulted into the risk that the key shareholder of the company might want to start using the company as a cash cow in order to repay its own shareholder debt, which was used, which was attracted to finance the share buyback of the company. So, for example, if before that company was doing some capex and some moderate operating growth, following such transaction, risks significantly heightened of the fact that the company may start to do aggressive distributions in favor of equity shareholders, but actually the key shareholder. This is also a risk that might put pressure on the credit quality of the company, because, probably this could result into the fact that the payments to the shareholder are dominated versus the payments to debt holders. One more risk which stems from such an exercise is that the company might start to, and this risk materialized, the company may start to attract debt financing on its own level in order to buy back shares from the shareholder, which he bought back from the market. And this is actually a way of how the company might do equity distributions in an aggressive way. It could either increase dividend payments, or it could attract debt on its own level and buy back shares from shareholder, and shareholder will use this money to pay for its own debt. So this is actually also a way of how you transfer your debt from the shareholder level to the level of the company. So these all the events that are hard to predict, they could still happen, and they can result into significant credit risks credit ratings downgrade. For example, this situation with the Polus resulted into the change of the rating by 3 notches, if I'm not mistaken. It happened a long time ago. If I'm not mistaken, Polus was rated BBB- or BB+, and it started to be rated somewhere at BB- or B+ level by, for example, Fitch, if I'm not mistaken again. So this was a huge downgrade, leading to increasing of costs of debt financing for the company. Later on, the company started to they sold shares again, so Polus is now an actually trading equity story on the Russian market, but still, this is how it happened. So, and finally, the fourth risk relying on credit ratings is that credit ratings lag market pricing. So what would I mean here? Market prices and credit spreads change much faster than credit ratings. The idea is that, credit ratings, in normal situation, the credit ratings are usually, again, depending on different rating agencies, but usually they are updated once a year. So the rating agencies, they provide, some regular update on the company's credit profile, and they do some amendments, if required, to its credit rating. Actually, important to mention that each rating agency has not only the credit rating, but also have a rating outlook. You, for example, can have a credit rating of BBB- with either stable, positive, or negative outlook. Stable means that there are no significant expectations on a short to mid-term horizon, usually somewhere 1.5 year horizon. That credit ratings might change unless there is some event risk which could materialize. Positive or negative outlook means that there is a high chance of credit rating to be either upgraded or downgraded, subject to some conditions which the rating agency highlights in its credit report. So usually rating agencies, they update their analysis on a yearly basis, making required amendments if there are factors driving them. But the idea here is that rating analysts, they usually lag in the market, and the market participants, investors, they usually have expectations of where the ratings might move, and actually they start to reprice the bonds given the expected improvement or deteriorating of its credit quality in advance before the rating agencies might update its year overview of the company. Still, if there is some kind of an event risk, if the company changes significantly some of its factors influencing its credit profile, definitely the rating agencies need to step in and need to do some urgent update to their ratings, again, if it is required. For example, you've heard probably about some accidents that happened on Norilsk nickel plants this year and last year. And even despite quite a notable reduction of expected production guidance for 2021, rating agencies, most of them, did not cut their ratings, but said that this will be, as of now, rating neutral. Still, one of the rating agencies cut its outlook because they said that there are risks that the company will have future ESG considerations, and this could also put pressure on its ratings unless the company addresses them in a proper way. So that's it on credit ratings. Let's move further, and here is general framework which CFA uses for the approaches to the credit analysis, and I expect that we move forward with this framework. It's quite wide, I would say, covering different angles of how you can view how you can form your view on the company's credit profile. So it is called 4 C's of credit analysis because it has 4 components. Each starts with the capital C letter. It's capacity, it's collateral, it's covenants, and it is character. So let's discuss it in more details. So first is capacity, and I would say this is actually the most quantifiable and the most fundamentally accessible and the most important for you, which I expect you to put the most pressure in your credit homeworks, which you are expected to complete. So the capacity focuses mostly on the borrower's ability to repay its debt on time and in full expected size. You see that, for example, in the very end, there is a character. And this is actually more about the management integrity and its commitment to repay the loan, and it will be actually more about the willingness to pay, while the capacity is more about the ability to pay, and this is an important difference. So there are 3 subcategories of how this capacity is expected to be analyzed. So the general approach here is a top-down approach. So you start with the industry structure, and the CFA here says that, guys, please go and use Porter's 5 forces to look into the industry's structure. So I will not stop on these Porter's 5 forces because you're expected to have already studied them in the economics section, I believe in your previous classes. But what we mean here, it's threat of entry, power of suppliers, power of buyers, threat of substitution, and rivalry among existing competitors. So you need to have a look at at how your company, at how the industry of your company operates and which factors could be risk factors under such analysis. The second way and the second actually factor is to look at the industry fundamentals. And here, I expect that you need to address and need to think about this under the next idea. It is to look at whether the industry is cyclical or non-cyclical. This is a crucial assessment because, well, the cyclical industries, they have greater sensitivity to broader economic performance, have more volatile revenues, margins, cash flows, and thus are inherently riskier than non-cyclical industries. Imagine we will be talking about, for example, the key credit metrics which are used, well, credit ratios which are used to assess the the credit healthiness of the company. One of the most important, or one of the most popular is well, the ratio which, well, the total debt or net debt to EBITDA ratio, and it shows the company's leverage. So it's, well, the calculates whether the company is leveraged or not. How you can interpret this? It's, well, in the you have the in the numerator you have debt, and in the denominator you have EBITDA. So it's just a way of analyze how many years of the operating performance company will need under the current situation to repay its debt. The higher the leverage, the higher the risks of the company. But think about how this ratio could change. It could change by the increasing or decreasing the debt, right? And, well, whether the debt increases or not will actually be affected by the company's operating performance, definitely. But for example, imagine your debt is stable, but, well, if your company is highly cyclical, for example, a very good example here is the company called Rusal. Well, it's not only operating into this in the cyclical industry, but it also has quite a high operating leverage. Combining all this together means that even if your debt is relatively stable, just fluctuations of your commodity prices, for example, will result in the significant deviation of your EBITDA, and your leverage will significantly, well, increase or decrease, even if you do nothing. For example, if you do not increase the dividend payments, if you do not increase capex, for example, but just because of the fluctuations of your operating performance. The same will not be true for non-cyclical industries. For example, some I don't know, some infrastructure companies, some utilities companies, and things like this. Definitely, the companies which operate on the commodity markets, like metals companies, like oil companies, they're considered cyclical, and you need to address this when you analyze the company. And I expect you also to put, to look into this when you will be, well, examining your companies. So the second factor to look here is the growth prospects of the industry. Well, everything is quite simple here. Probably your industry is not cyclical, and it's good. But for example, well, you have an industry which is not increasing but decreasing, and, well, you need to understand why, whether the trend is sustainable or not, because it's not a good for assessing the company's credit risk when your industry is narrowing or is decreasing. So yes, published industry statistics, it just stipulates where the analyst can get an understanding of industry's fundamentals and performance by research and statistics that are published by and available from a number of different sources, including the rating agencies, investment banks, industry publications, and so on, so on. So, and the third factor here is, well, we started from top down, now we are on the bottom level. So the third sub factor to look into the capacity analysis is the company fundamentals. And here you need to look into this under different, again, sub-factors. The first is a competitive position. There are a number of questions which you, well, probably it's not a full list of questions, but it's a way of thinking, and probably you do not need to answer all of them, but still, you need to think about its competitive positions of the company in terms of what is its market share, how has it changed over time, how is the company, well, positioned versus its peers, is it well above or below, How does it compare with respect to cost structure? How might it change its competitive position over the time? What source of financing might that require? So this is a way of thinking of how the company is possessed on the market in terms of its market share, what are trends regarding this market share, and what is the company position regarding, or but to say, versus its peers. So the second is track record and operating history. So you need to look into how has the company performed over time. It's useful here to go back several years and analyze the company's financial performance, perhaps not only during the current business or industry cycle, but also during times of both economic growth and economic contraction, in order to get understanding of, well, whether the company performed well under different part of the cycles. So here you also are expected to look what are the trends in revenues, in margins, well, definitely in EBITDA as a result, and the cash flows. What percentage of revenues are applicable to capital expenditures? What are the trends on the balance sheet? What is the proportion of, well, allocating debt or equity resources? And so on. And finally, you're expected to look, actually not finally, you're also expected to look at the management strategy and execution. What is the management strategy for the company to compete and to grow? Does it make sense? How risky is it? Is it venturing into unrelated businesses? Does the analyst have confidence in management's ability to execute announced strategy? And what is finally the management's track record, both at this company and previous ones? So all here on this slide is attributable to the business description of the company, its business performance, and its operating performance, how the company operates and how the company is expected to operate under different scenarios, and whether the management is experienced enough and its strategy is could be realized, and whether its previous track record is successful. And finally, when you are expected to look into the company fundamentals analysis, you're expected to look into its financial condition and to analyze its, well, key financial ratios. Well, we're not doing here a valuation class, so we are not doing some estimated of the company's fair price and things like this. So the financial analysis and the credit analysis is not quite complicated. You usually, well, calculate some leverage ratios, some coverage ratios. You look into your expectations of margins, which we already discussed, and we will talk about this a little bit later. This is especially true for lower rated issuers. You look into the liquidity, whether the company has enough liquidity to pay its debt. So you analyze its sources and use of liquidity. So these are two major components of the financial part of the analysis. Calculate ratios, understand whether they are high or not, how do they compare with the peers, with the peer group of the company, and analyze its liquidity, whether the company have enough sources of liquidity to address the required uses of liquidity. So first, again, this liquidity analysis is mostly attributable to high leveraged issuers, and for example, CFA stipulates you to use this approach when you assess non-investment grade issuers. Well, this is quite reasonable, because if the liquidity is not quite high, the investment grade issuers would not be investment grade, because the liquidity factor is significant in the rating agency's approach. But still, I would say that you need to think about the liquidity issues in your real life experience, even if you talk about, or even if you examine the high rated companies. Because again, this is actually the key source of paying your debt. So this is actually what you should be interested in. As for the key financial ratings in credit analysis, there are two big groups, well, leverage ratios and coverage ratios. And well, in your exam, you will also have questions which will require you to, you will have some tables with the already calculated ratios, and you will need to answer the questions whether the company is highly leveraged or which company is the most leveraged among those that you will have in the table, based, for example, only on leverage ratios or coverage ratios. And the answer might be different depending on which ratios you will need to look. So please understand the difference between them and understand how you should treat them. So as for leverage ratios, there might be different ratios. Here on this slide, we have the most applicable among them. The first one is debt to capital. So capital here is, well, not the what you can take from the equity part of your balance sheet, but actually capital here is the sum of shareholders' equity, which you have on the balance sheet, and its total debt. While the debt is, you should calculate it from the balance sheet, and the debt, well, I had an experience with, well, I assume that you are quite well acquainted with the financial statement analysis. You are assumed to be at least, so I would not expect you to use the total liabilities as the debt, but sometimes I had the calculations which study groups provided to me, and they just took the total liabilities from the balance sheet and said me that this is the debt. Definitely not. For the debt calculation, you should use the interest-bearing liabilities of the company, meaning that this will be bank loans, this will be the bonds, euro bonds, or some money market instruments. These would be leases. In previous times, we had the financial lease and operating lease. Financial lease was the on-balance sheet. You were able to find it in the balance sheet section, while operating leases, they were like off-balance sheet liabilities. You had them in the income, in the income statement in the expense section, but you didn't have them in balance sheet, so you needed to do some adjustments. Now in the latest IFRS, under the latest IFRS version, the operating lease is already reported on the balance sheet, so you do not need to do these amendments anymore. But please be careful, and when, well, in your real life, if you will have some challenges like this, or in your homeworks, some of your companies will have not only on-balance liabilities, but they will have some off-balance sheet liabilities. In form of, for example, what? In form of guarantees. You will not see them on the balance sheet, but if you go into the note, which describes in more details the debt section, you will find this information, and you will need to adjust your debt calculations to incorporate these off-balance sheet liabilities into your calculations. So the ratio itself is quite easy. A lower ratio indicates less credit risk. The higher ratio definitely brings you the higher risk. The second ratio is debt to EBITDA, and this is actually the most popular and the most used ratio on the market. It can be either the total debt to EBITDA or net debt to EBITDA. So the total debt we already discussed. It's all interest-bearing liabilities on the balance sheet of the company, together with the off-balance sheet liabilities, interest-bearing liabilities of the company. What is a net debt? net debt is actually your total debt minus minus cash actually. But this is maybe a little bit more simplified approach. You can calculate it in different ways. Well, the easiest way is just to subtract the cash on the balance sheet, but sometimes the company has, for example, a huge amount of short-term investments which are disclosed into the current assets section, and you need to dig deeper whether you can consider them as quasi-cash or not. For example, if these short-term investments represent some, well, loans or some money market instruments issued by some low-rated issuers, well, there is quite a lot of questions whether the company can highly or can quickly convert them into the cash with well, not losing money. So I would say that you should not use them as a cash equivalent. But for example, if these are just if these are short-term bonds or short-term notes or whatever, I forgot the word for vexilla, for example, of high-rated banks, corporates, then I would say this could be considered as cash, and you can also deduct this from your total debt, which will result in a lower net debt. But the basic rule is that you stay conservative and do not deduct too many from your total debt to calculate your net debt, because, well, you are a credit analyst, you are not an equity analyst. You should not be aggressive, you should be quite conservative. So this ratio, again, a higher ratio indicates higher leverage and higher credit risk. As we already discussed, this ratio is more volatile for companies in cyclical industries or with high operating leverage because of their high variability of EBITDA. This was just an example of Rusal. We already talked about this. Well, the general idea is that the net debt to EBITDA of up to 3 to 3.5 is, well, relatively fine. It's fine to go. The ratio higher than 3.5 is considered to be a highly leveraged name. But again, you need to understand why it is. And you cannot just tell me that this ratio is 4 and it's high. You need to compare it with peers. For example, if you have a metal company in Russia in universe, well, in the beginning of 2010s, the majority of them had a leverage of somewhere close to 3, 4, some things like this. Now, even despite being positioned into the quite cyclical industry and being quite capital intensive, well, represented quite capital intensive industry, the leverage is quite low, just because the majority of them decrease capex and just because the metal prices are quite high and comfortable. But for example, you can take some well, non-cyclical company from non-cyclical industry, for example, some infrastructure company, and see a leverage of 6 to 7. On the one hand, it looks like quite a high leverage, but given that this is an infrastructure company with a very stable cash inflows, with quite predictable cash inflows, with no cyclicity in the industry, this will not be considered, well, a high leverage, because you need to compare it with other infrastructure companies, and well, probably you will see even a higher leverage. So I believe let's make a break, 10-minute break, and then continue. У вас, я так понимаю, никто офлайн не ходит или ходит?
Ходят.
А?
Иногда. Ходят иногда.
Ну, то есть это ко мне только не приходит, или вообще в целом не приходит?
В целом ходят.
Ну, просто к тому, что, может быть, нам тогда проще это в онлайн формате провести.
Сейчас неделя просто тяжелая. С курсовыми и дедлайнами.
То есть у вас там не только мои, да, еще другие какие-то будут? Ну, не только мой, не только моему курсу, по другим тоже курсам.
Да.
Что у вас идет параллельно?
Венчурные инвестиции.
Да, понятно, что я не возрастаю.
Научная связь с Симулатором.
А?
научная исследовательская система была. Еще оценка стоимости компании.
Мгм. Что-то темно, да?
С каких первых?
А?
С каких первых?
Да вот я хотел уже начинать.
Хотите
выйти, но идите, если хотите. Подождем еще пару минут.
Да.
Пойдете? Не пойдете? Ну, все равно еще 2-3 минуты. So okay, let's continue. So one more thing on this debt to EBITDA ratio. Actually, well, I had some questions on, well, which ratio should you use? How you should, how you should think about the approaches of using either total debt to EBITDA or net debt to EBITDA. Actually, there is no correct answer because, well, you should be able to understand, well, the difference between them and, well, to interpret different results of the calculation. For example, imagine a company which had, I would say, well, somewhere in the early December, it has a, well, yearly EBITDA of, well, $100 million, and it has a debt of $300 million. So, and it has, well, assume it has no cash. So its total debt to EBITDA and its net debt to EBITDA will be equal to each other, and it will be equal to 3. For example, in the course of December, the company, well, attracts $300 more in form of bonds, So, and doesn't spend this money. So by the year end, we receive that its total debt to EBITDA will be 6 and its net debt to EBITDA will be 3. And here the difference is significant. Which one should you consider? It depends on how the company will actually use its money. For example, if it will use this money to refinance the previous debt, for example, in the first quarter of the next year, and it will fully, or at least in part, redeem the existing debt with the newly attracted funds. So this is fine because, well, it doesn't use money to, for example, pay shareholders, and it's fine. Your leverage will be close to the initial value, and it's good. And this is, well, why you might be more, well, it will be more correct to use net debt to EBITDA because your total debt to EBITDA will significantly overestimate the company's leverage. But, for example, alternatively, company might use the raised funds not to repay its debt, but, for example, to either finance a significant capex or, for example, to pay significant dividends. Then your not your debt to EBITDA will merge to your net debt to EBITDA ratio, but your actually net debt to EBITDA will merge to your total debt to EBITDA ratio. And this means that, well, you underestimated the leverage if you looked only at the net debt to EBITDA level. Well, in order this not to happen and not to significantly influence the company's profile, you use covenants actually, which we already discussed. But again, it's a way of how you should think about this and where you should be quite where it should put quite enough attention, because, well, you need not only understand that the company might raise money, but you also need to study the covenant package, and this is actually one of the factors of this 4Cs framework analysis. You need to understand the covenant package of its existing debt and to understand what are the restrictions, how the company might use these funds. So next one, it's FFO to debt. So fund from FFO, it stands for funds from operations. Well, you can calculate it differently, but this is generally is your net operating cash flow, but excluding the changes in working capital. In some form, this could be named like a proxy of EBITDA of the company. But as a cash flow measure, it is well, a more precious estimate of cash flow rather than an income statement measure, which can be influenced by some non-cash charges. Some rating agencies, for example, in their approach, mostly rely on debt EBITDA or total net debt EBITDA ratio. Some use, for example, cash flow measures. Well, I would say that calculating both is quite important. But, well, again, total debt to EBITDA ratio is quite often used. It's easier to compare between different companies and industries, while using the measures based on the cash flow statement, well, they are more precious in terms of well, estimating the company's real leverage. So it's quite reasonable to look into both of them. So here, please keep in mind that your well, your balance sheet measure, your debt is now in the denominator, so this ratio works inversely. And, well, the higher ratio here indicates actually the lower credit risk. Then, for example, it's different from the debt to EBITDA ratio. And finally, sometimes you might use free cash flow after dividends. Again, you can use whatever you want. You can use free cash flow. Here is just a list of, well, most use ratios. So you can use also free cash flow after dividends divided by debt. You might ask me, why should we account for dividends? Because, well, the equity stakeholders should be treated only after the lender, after the banks, after the bondholders. On the one hand, you are right, but on the other hand, well, it again depends on the covenant structure, and sometimes the company could pay dividends, and even despite the fact that this will lead to higher debt. For example, in the Russian market, we have an Narinsky company who is paying quite generous dividends under its stated dividend policy, and actually it uses debt to finance its dividend payments because its debt is all the time is rising. But its leverage is still quite stable in terms of debt to EBITDA because, well, the company's debt is rising because of high capex, high dividend payments, but this high capex translates into the higher EBITDA together with, well, the increased prices into its products. And all this results that EBITDA is growing and debt is growing, and, well, leverage is quite sustainable. But still, you need to keep in mind that the company is paying dividends and is increasing debt, which is derived not only by capex but also by paying dividends. So it's important to look how it could influence the credit profile. This is not bad, but, well, unless significant changes happen to its metal basket prices, it's not bad, but should be incorporated into your credit analysis. You should understand the risks of this company and so on. So as for leverage ratios, we're done. As for the coverage ratios, well, there are actually two of them, but they are very similar. First is EBITDA divided by interest expense, and the second one is EBIT divided by interest expense. You see that, well, they're actually the same, but your EBITDA is usually not usually is less than your EBIT because your EBIT is lower than EBITDA because EBITDA, well, is before deducting depreciation and amortization, and thus using EBIT to interest expense is a more conservative approach because your numerator is less, but still the idea is the same. Both these ratios, they show how your operating performance of the company is compared to your interest payments. So the red flag here will be if your ratio is somewhere close to 1 or less than 1. If it is less than 1, it means that what you earn from the operating activities is not enough even to pay your interest payments. We are not even talking about repaying that principal, but will not be enough even to pay your interest payments. And this is, well, actually a red flag. If it is somewhere close to 1, it's also a red flag because you're fine to pay your interest payments, but, well, you're somewhere close to the break-even level. So usually the ratio above 3 is quite comfortable. Of at least 3 is quite comfortable. So let's move further. I believe we can skip this example. So now back to these 4 C's. We talked about the capacity, we talked about the industry structure, industry fundamentals, and company fundamentals. Now let's talk about the collateral, covenants, and character. So collateral. Collateral is actually what is the quality of the assets of the company which you buy, because, well, collateral is not some kind of a secured debt, but generally if it is in an unsecured debt, you have you have claims against the overall company's balance sheet. So it's again a matter of how you assess its quality of its assets. So collateral analysis is more important for less credit-worthy companies. Only when the default probability rises to a sufficient level, analysts typically consider asset or collateral value in the context of loss severity in the event of default. So 4 factors to pay attention here. First is to look into the intangible assets. You should evaluate of how the intangible assets, which share in the total asset structure they account for. If it is quite significant, you need to understand why this happens, because, well, usually if you have some production company, I would assume that the majority of in the asset structure, the PP&E should dominate, right? Because your production company, your property, plant, and equipment should be of significant cost. But for example, if of significant cost are intangible assets, this is actually a red flag. Then you need to dig deeper. What are your intangible assets? For example, if you have some licenses for some mines or some patients, for example, these are considered some high quality intangible assets because they can easily be sold to generate cash flows, and for example, because you understand what are they. But for example, if goodwill plays a significant role within your intangible assets, this is not good, because the goodwill is usually a result of previous M&A activity, and is the difference between, it's an accounting stuff. It's usually a difference between the price which company pay for it's the difference between the price which company paid for the assets and its balance sheet value, and it's just, again, as I said, accounting stuff, and usually should be tested for impairment and things like this, and it could be written down when company performance is poor. So all this actually is not good if the share of goodwill is quite significant in the structure of your assets. The second thing is look into the depreciation. So if you did some finance modeling, you probably understand that you usually basically do the modeling of your PP&E through increasing in future periods, increasing them by capital spendings and decreasing them by the depreciation. So the idea here is thus straightforward. Your high depreciation expense relative to capital expenditures may signal that management is not investing sufficiently in the company. This means that your PPE is decreasing because your assets are probably old, or maybe your capex is not significant, and this is a red flag, and you need to understand why this happens. Third thing here to look into is your equity market capitalization. A red flag will be a stock that trades equity market capitalization of the company, which is less than the book value of its asset. So this might signal of low quality of assets, and the fact that market participants, investors, they assess the quality of the assets as low. So, and finally, human and intellectual capital. These are quite difficult to value, but a company might have intellectual property that can be function as collateral. So as for the covenants, we already discussed that covenants are the terms and conditions that borrowers and lenders have agreed to as part of a bond issue or of some credit line. Covenants protect lenders while leaving some operating flexibility to the borrowers to be able to run the company. We discussed there are two types of covenants: the affirmative covenants and the negative covenants. So the affirmative covenants, they require the borrower to take certain actions, such as, for example, to pay interest, to pay principal, to pay taxes, to carry insurance on some assets, to maintain certain financial ratios within prescribed limits, and so on. So they are mostly administrative purposes. They mostly follow the administrative purposes, and they are not usually costly to the issuer. The negative covenants, they restrict the borrower from taking certain actions while not requiring the borrower to take certain actions, as affirmative covenants do. So these restrictions on the borrower actions might include incurring an additional debt or directing cash flows to shareholders in the form of dividends and stock purchases. It could also include some kind of restrictions on liens. It could also include some restrictions on demerger of assets, on M&A activity, and so on and so on. All this stuff we went through in the beginning of our course when we discussed the key differences between these covenants and their examples. One last thing to remind you about the covenants is that don't forget that your covenant package on the bond should be strict enough to restrict the company from some aggressive movements that could hurt lenders, but it should not be strict enough so that the company will still have some flexibility on ability to normally operate under its normal operating activities. So we talked about the first three C's, and finally the fourth C is character. Character refers to management's integrity and its commitment to repay the loan. And character analysis includes an assessment of first soundness of strategy, which is management's ability to develop a sound strategy. Its track record, so it's how management's past performance in executing its strategy and operating the company without bankruptcies, restructurings, or other distress situations that led to additional borrowings, for example. Third one is its accounting policies and tax strategies. It's use of accounting policies and tax strategies that may be hiding problems such as revenue recognition issues, frequent restatements, and frequently changing auditors. We had recently an example of Petropavlovsk company. Well, actually, some of you will have this company as your homework, and this is actually a small spoiler to you. The company had problems with assigning an auditor because they lost contract with the auditor which they had before, and they were unable to hire a new auditor, and they had covenant which stipulated that they need to provide in the particular time periods, within the particular time frames, they need to provide the audited or at least reviewed by the auditor consolidated financial statements. And because they had these problems with naming the new auditor, with hiring the new auditor, they were close to a potential situation when the bondholders might raise claims to them to redeem the bond issue because they were unable to publish these audited financial statements. Hopefully they managed to be actually they asked for waiver, and then they named the auditor, and actually they finally coped with this problem. But this actually how this could work. So the next one is fraud. So any record of fraud or other legal and for example regulatory problem which the company might face. Well, and finally here is prior treatment of bondholders and generally lenders. So benefits to equity holders at the expense of debt holders through actions such as debt finance acquisitions and special dividends, especially if they led to credit ratings downgrade. This is an example which I actually today discussed about the Polus. This is actually how the company treated bondholders and which results they achieved by this. So also you should actually in your home reports, you should not go through all these slides. You should go through your, the most, I would say, important things. But this particular factor, I mean, the prior treatment of bondholders and lenders, this is actually important because some of you will have companies which, in previous times, they were under the restructuring or under the default. And actually, I would say that it is important to see how the company went through these hard processes and what they did with their bondholders and with their lenders, because this is actually a particular risk of how the bondholders and how the investors of the new companies will be treated or might be treated should the situation repeat once again. So what else to discuss here? Let's talk about how this credit risk is positioned versus return. Here we need to talk about yields and spreads. So as we already discussed, the yield on a corporate bond is equal to a number of factors. They could be split into two groups. So the first is, well, is depicted in green in the slide and includes the real risk-free interest rate in the in the currency of the bond which we examine, expected inflation rate, and some kind of maturity premium. So this is actually what is attributable to benchmark rates which we have in our examined market. For example, if we speak about the Russian market and the Russian ruble market, we will be talking about the OFZ, for example. So we take the real rates, we take the expected inflation rate, and we take the maturity premium, combine it all together, and receive our nominal yields, well, let's say on our risk-free instruments. Sorry, 1 second, I will once again need to answer the call. Sorry for a pause once again. So this thing which is marked in green is actually like a benchmark yield. And the second factor, the one which is depicted in red, this is actually the credit spread, the credit premium, and the liquidity premium. These are mostly the bond specific, and these are driven by the specific factor of our particular, for example, company or region or whatever. So this is actually our yield spread, which consists of two components here. So yield spreads on corporate bonds are affected primarily by 5 interrelated factors. And you can see them on the slide. The first one is a credit cycle. So the market's perception of overall credit risk is cyclical. At the top of the credit cycle, the bond market perceives low credit risk and is generally bullish. Credit spreads narrow as the credit cycle improves, and credit spreads widen as the credit cycle deteriorates. So actually, it's quite essential. And when credit cycles improving, you will have narrower credit spreads, while the opposite is true when the credit cycle is deteriorating. So the second is economic conditions, or let's say just broader economic conditions. So the weakening economic conditions will push investors to desire a greater risk premium and drive overall credit spreads wider. Conversely, a strengthening economy will cause credit spreads to narrow because investors anticipate credit measures will improve due to rising corporate cash flow and thus reducing the risk of default. So the third one is financial market performance, in global context and including the equities, not just like a bond market. In weak financial markets, credit spreads will widen, whereas in strong markets, credit spreads will narrow. In a steady low volatility environment, credit spreads will typically also narrow as investors tend to reach for yield. And this is actually what we've seen in recent years. hunting for yield when everything is low yielding, and this actually drives all the yields and all the spreads even lower. The fourth one is a broker-dealer capital. Because most bonds trade over the counter, investors need broker-dealers to provide marketing capital for bond markets to function. And yield spreads will be narrower when broker-dealers provide sufficient capital, but can widen when market-making capital becomes scarce. And finally, general market supply and demand. So in periods of heavy new issue supply, credit spreads will widen. Well, just because that's what I discussed, not in terms of spreads, but in terms of yields when we last time discussed the OFZ market. Last year, we saw a huge supply from Ministry of Finance on the primary market, and this actually drives the long-end OFZ's yields higher because huge supply, not enough demand, and people, investors, they require a higher yields, higher premium, higher spreads. You would talk about the credit bonds versus the normal situation. Opposite is true, and when we see periods of high demand for bonds, spreads and yields will move tighter. An important factor here to mention is that all these 5 factors, they are not isolated. They are actually interrelated, and in real life examples, they are significantly interrelated sometimes. So this is important to keep in mind. So I will actually talk about this later on when we talk about the Russian market. So a few words of yield spreads over benchmarks. So a yield curve shows the relationship between yield to maturity and time to maturity for securities with same risk profile. And we will discuss yield curves. We actually already saw them last time when we discussed the how the Russian bond market functions, and I demonstrated you slides with the yield curves on the OFZ market, but I will elaborate more on this next time when we talk about valuation things on the fixed income instruments. Now let's talk more about yield spreads. So the yield spread in basis points over an actual or interpolated government bond is known as the G spread. G here stands for government spread. So this is actually the easiest way of calculate your spread, and it is just the difference between the yield on your risky bond minus the bond of the minus the yield of the government bond of the same or similar maturity. So you take two dots on the yield map and calculate the difference in yields, and you receive your G spread. So this is actually what you in reality will use most of the time, the G spread. So as I already mentioned in the very beginning, we also have the I spread, or interpolated spread to the swap curve, and this is the yield spread of a specific bond over the standard swap rate in that currency and of the same tenor. So you take the yield on your risky bond, on your corporate or original bond, for example, and you simply calculate the difference over the standard swap rate of the same tenor and definitely of the same currency. This is also a usually used measure, but actually the G spread, I would say, is used more often. So benchmark yield curves tend to be upward sloping. For example, you saw that last time on the OFZ market examples. Why? Because investors typically demand a premium for holding longer term securities. This is actually what is true when the markets function normally. You can see an inverted curve But again, we will talk about this later on. But this is actually one when the situation is not normal. So in general, investors face greater price risk for a given change in yield for longer-term bonds. So the G spread and I spread each use the same discount rate for each cash flow, because we use our yield to maturity in order to calculate our present value of the cash flows, and well, we use the same yield to maturity to calculate yield to maturity to calculate the price of our bond. And this is one of the limitations of this method. Again, we will do all these calculations next time. And I believe this will be better understand next time. A different approach is to calculate a constant yield spread over a government spot curve. Again, we will elaborate more about the spot curve next time, but I just want to introduce here a zero volatility spread, or so-called Z spread, which is also very often used on the bond market. So Z spread is constant spread which is added to the spot curve to the spot rate in different parts of the curve, but still the spread itself is stable, and it will help you to incorporate the fact that the curve is not flat, but you have a premium for holding long-term securities, and the curve is upward sloping. Maybe a little bit not enough transparency at this point of time, but let's revert to this discussion once again next time when we discuss the spot curve in more details and when we talk about spreads once again. So few things here about high yield bond analysis and different additional considerations that you need to be aware of when analyzing these non-investment grade bonds. So there might be a lot of reasons why the companies might be rated below investment grade. We cannot name all of them, but at least you can see some of these, the most popular factors for this on the slide. So the reasons include the fact that the company might have a highly leveraged capital structure. It can have weak or limited operating history. It might have limited to negative free cash flow. It might be operating in the highly cyclical business structure. It might have poor management or risky financial policies. This is important. It might have lack of scale and/or competitive advantages, large off-balance sheet liabilities. It might be functioning in the declining industry. So again, not usual case when only one factor will significantly drive, significantly, I would say, downgrade the credit quality and credit rating of the company, but some number of factors which might drive all these credit risks higher when combined with each other. So when assessing the high yield debt, and actually if you will work on the Russian debt market, I told you that the Russian rating, the sovereign rating is slightly above the break-even level, or even under the some rating agencies it is at the level of the break-even level. So minor fluctuations could result into the rating downgrade in Russia being again in the high yield rating segment. And as I already mentioned, your corporate bond ratings, they are capped by the sovereign rating or sovereign rating ceiling, which is close to the sovereign rating. That means that you have a lot of non-investment grade issuers in Russia, and you will have non-investment grade issuers in your homeworks. So several things that you should be aware of. And the first one, which I already mentioned, is liquidity. So liquidity or availability of cash is critical for high yield issuers. High yield issuers have, well, relatively limited access to additional borrowings, or at least might have such limited access. And available funds tend to be more expensive for high yield issuers relative to investment grade issuers. Bad company specific news and difficult financial market conditions can quickly dry up the liquidity of debt markets, and many high yield issuers are privately owned and cannot access public equity markets for required funds. So when assessing an issuer's liquidity, credit analysts tend to look at the following factors. The first and the essential source of the liquidity is cash on the balance sheet. I already mentioned that you should look on the balance cash, and you should also look on the short-term finance investments if they are of a high quality. All these could be considered as potential sources of liquidity. Second one is net working capital. So this could be as a source of liquidity, and this could be a use of liquidity, depending on what is expected to happen with your working capital. For example, if the company will be reducing its inventories, this can be a source of liquidity because it will free some of the funds which are currently locked in its inventories. Opposite is true. For example, if the company is launching a new plant and it needs to invest into its, for example, inventories, well, it will be your cash outflow, and it will be a source of liquidity. So your operating cash flow, this is actually the key source of your new funds. Well, and the usual case is that analysts will need to project this figure a few years in advance and consider the risk that it may be lower than expected. In your homeworks, I actually would not ask you to build financial models because it's quite, well, on the companies, because it's quite, I would say, heavy intensive, and well, we are not doing valuation class here, but I would at least ask you to think and to mention on the slides where you expect the company's financial to move, what trend do you expect in the future, because otherwise it will be quite hard to understand whether the company might have liquidity problems or not. Once again, if you want, please proceed and do at least some basic financial model. For example, assume that revenue will grow with some fixed rate, or think that you will have increasing production given the company production guidance, and you will have fixed prices, and for example, you will have fixed margins. Or you can dig deeper and well try to move with a full financial model. Depends on you. I will not require a financial model, but I will, if you do not put some information on your slide regarding the trends and future expectations of the trends on the revenues, margins, EBITDA, operating cash flow, I will ask you questions about this, so be ready. So one more important thing to look into, and you will need to do this also in your credit reports, is to examine what bank facilities available the company has. Usually company discloses this in their either financial statements or in their financial presentations. When they speak about the debt, they say, well guys, we have liquidity of $1 billion in cash, and we have an access to 1 billion available of undrawn bank facilities, bank lines, and things like this. Some companies disclose separately committed and uncommitted credit facilities, some not. You should be aware of this, and this is actually quite crucial because, the rating analysts, they take into account only committed bank facilities, because the committed bank facilities is the facilities that companies are paying commitment fees to the bank, and if something happens, the company can attract funds through these committed bank facilities, and banks cannot refuse to give the company these funds in the limit of, well, which was stipulated by the terms and conditions. At the same time, the uncommitted credit facilities, well, it means that the company just signed the terms and conditions with the bank, but, well, they do not pay any commitment fee. And if significantly the situation significantly changes, the banks are not so they're not obliged to provide this liquidity. So if the market liquidity is dried up, probably the banks will not provide this liquidity to the company. So I would ask you to look into the available liquidity to the company in form of undrawn bank facilities, and if you're able, if the company discloses this, then to use the committed facilities. Well, if you cannot do this, just say that these are all facilities available to the company and you do not have enough information to judge whether they are committed or not. So other sources of liquidity is equity issuance, is the ability to do some IPO or SPO and to attract the money through equity issuance, which can be used to, well, either for capex or debt refinancing, decreasing its debt and leverage. The similar thing is an asset sale. Well, you can sell some of your assets if you are not restricted by covenants and use the proceeds from asset sales to fund your debt, for example. So while the use of your liquidity is the debt which comes due and your committed capital expenditures, well, the usual horizon which you should be focused on is somewhere of up to 2 years or up to 1.5 years. So you need to understand how the above mentioned sources of liquidity will correspond to these expected uses of liquidity in form of debt coming due, not only interest but principal as well as the committed capital expenditures, because, well, usually the company discloses its capex plans, and you can just look into the press releases. The management discloses this. The transparency is quite good nowadays. You sometimes will see that the company have some development capex and have some maintenance capex. So maintenance capex stands for some required capex because the company needs this just to be able to use already possessed assets. The development capex this maintenance capex is usually committed capex because the company will just need to finance the current assets. While the development capex can be either committed or uncommitted, and, well, should the situation worsen, part of this capex might be, which is uncommitted, might be decreased in order to better address the issues of potentially deteriorating cash flows which the company expects to receive, again, if the situation is expected to worsen. So here again, when we talk about the high yield special considerations, an important thing is to look into the covenants. Why? Because the covenants are usually, there are much more covenants in the high yield debt relative to the investment grade debt. I will not again go through all the covenants. We have already done this in the beginning. So once again, the covenant should be quite restrictive for the company not to be able to favor shareholders versus lenders, but they need to give the company, still need to give company some flexibility to be able to operate, to function quite efficiently. So covenant package analysis is a part of what I expect to see from your homeworks, and it is important. So I will provide you the bond prospectuses of bond issues which I would ask you to look into, and I will ask you to go to the terms and conditions of these bond prospectuses and analyze which covenants do the company have, and also look at the carve-outs from these covenants. I told you that, for example, the company might be restricted. Well, the first covenant here is the restriction on debt. So the company might be restricted on increasing leverage. We discussed that this could be in the form of either maintenance or incurrence covenant. Maintenance means that should the company break through the threshold level, the bondholders might require the company to redeem the bond issue, and if the company cannot do this, the company will be in the event of default. While the incurrence covenant will not result in an event of default, but should the company break the threshold level, the company will be restricted from incurring new debt other than the debt which the company will use to refinance the existing debt. Still, I used an example with Petropavlovsk, which refinanced its $100 million convertible bond, which was due in 2020, if I'm not mistaken, with a new 4-year bond. The company was not in compliance with its incurrence debt covenant. The leverage of the company was higher, but still the company was able to attract not $100 million, which coincided with the amount of maturing bond issue, but the company attracted $125 million. Why it was able to do so? Because the company had a covenant with a carve-out saying that, okay, the covenant restricts you from incurring new debt other than the one which you will use to refinance the old $100 million issue, but we have a carve-out of 25 million, meaning that, okay, guys, you still can increase your debt, but just by $25 million. And these $25 million were quite crucial for Petropavlovsk in this period of time, because the company received the ability to attract extra funds and to use them not only to redeem the debt, but also to finance additional capex, which was quite crucial for the company, because it will significantly improve its operating efficiency in the coming years. So this is important, and this is important way of how I expect you also to look into the bond prospectuses. So here are an example of covenant comparison of different companies, and I expect you to do something similar, but maybe not that way exhaustive, maybe in a more brief way, but still you see a different kind of covenants to the left, and you see the type of a covenant and what it prohibits company to do, and whether do you have such covenant in the bond package or not, and whether you have some carve-outs on this. You see, the first one goes to limitation on indebtedness, and we put here the level, so what is the maximum level of leverage, and whether the covenant is incurrence or maintenance. Then you see the limitation on indebtedness, the same covenant, but you see carve-outs, whether you see whether the company can still increase debt even despite it is not in the compliance with the covenant. The same for limitation on liens, whether the company has restriction on payments or not, a limitation on asset sales, and things like this. I would ask you to examine the bond prospectus and to analyze different type of covenants which we discussed and which you saw on the slides. I will provide you with these slides tomorrow, and to do an analysis of bond covenant package. That's why we will do 2 iterations of my review of your presentations, so that I can give you comments on whether you are fine with all the information which you have in the presentation or not. This is how we actually do it iteratively, and how you will do credit analysis and understand different ways of how you should work with this problematic. So, and finally, few words about the credit issues when you look into the sovereign and sovereign debt and non-sovereign government bonds. I mean regional and bonds and other municipal bonds. So as for the sovereign debt, as we discussed, it is issued by national governments. Sovereign credit analysis must assess both the government's ability to service its debt and not only ability, but also its willingness to do so. The assessment of willingness is important because bondholders usually have no legal recourse if national government refuses to pay its debt. And it is, well, an important difference versus the corporate, because if the corporate is not willing, you go to the court. If sovereign is not willing to pay, which court you will go to? The court which is controlled by the same sovereign, I believe it will not be efficient. So a basic framework for evaluating and assigning credit rating to sovereign debt includes 5 key areas. The first one is the institutional assessment, which includes, well, successful policy making, minimal corruption, checks and balances among institutions, and the culture of honoring debts. The second one is economic assessment, which includes, well, growth trends, income per capita, and diversity of source of economic growth. Third one is the analysis of the external position analysis, which includes the country's foreign reserve, how it coincides with its external debt, what is the share of short-term external debt, does the sovereign have enough reserves to cover it, and what is the status of its currency in the international markets. Finally, two assessments of, well, its fiscal and monetary policy. Fiscal policy, the assessment of fiscal policy includes, well, the government's willingness and ability to increase revenue or cut expenditures to ensure its debt service, as well as trends in debt as a percentage of GDP. And finally, monetary assessment includes the ability to use monetary policy for domestic economic objectives and the credibility and effectiveness of monetary policy. So credit rating agencies assign each national government 2 ratings. First one in a local currency and the second one in a foreign currency. The ratings are assigned separately because defaults on foreign currency denominated debt have historically exceeded those on a local currency debt. Foreign currency debt typically has a higher default rate and a lower credit rating because the government must purchase foreign currency in the open market to make interest and principal payments, which exposes it to the risk of significant local currency depreciation. In contrast, local currency debt can be repaid by raising taxes, controlling domestic spending, or simply printing more money. This will not usually be this will not usually be the case because, well, even if the government might print more money to pay for local currency, that it will not all the time do so. And an example is the Russia crisis of 1998. So the ratings can differ as much as 2 notches for local and foreign currency bonds. Sovereign defaults can be caused by different events, for example, such as war, political instability, severe devaluation of the currency, or large declines in the prices of the country's export commodities. And access to the debt markets can be difficult for sovereigns in bad economic times. We all know different sovereigns. Well, sovereign defaults is not a catastrophe. Well, the investors' memory is quite short. We have an Argentina who, in the course of the last 100 years, defaulted, if I'm not mistaken, 15 times, or even more. So, if speaking about non-sovereign government bonds, this is debt which is issued by local governments. What is important here is, most municipal bonds can be classified as, well, either general obligation bonds or revenue bonds, which are unsecured bonds, but they are backed by the full faith. They are backed by the full faith credit of the issuing government entity, which is supported by its taxing power. And they can be in the form of revenue bonds, which are, well, issued to finance specific projects such as infrastructure projects, toll bridges, hospitals, airports, roads, and so on and so on. And they are covered by a cash flow which is provided by such projects. So, unlike sovereigns, regional governments cannot use monetary policy to service their debt, and usually must balance the operating budgets. And this is a significant difference, and we already discussed it in some details. That said, regional government's ability to service their general obligation depend ultimately on the local economy. In other words, on the tax base. Economic factors to assess in evaluating the creditworthiness of general obligation bonds include employment, trends in per capita income, in per capita debt, and definitely its tax-based dimensions. What is the depth, breadth, and stability? Credit analysis also includes, the analysis of the revenue reliability through economic cycles and how the budget of the region or municipality will differ under different market and economic situation, and is there any support from the federal government in forms of budget loans, in forms of subsidies and things like this. I believe that's it on the credit research side. Now, finally, let's discuss what do we expect to see in your homework credit report. I will say that there is no general. I will not give you any particular guidance that, guys, please do me 2 slides on industry, 2 slides on business profile, and things like this. I believe that you need to understand, the overall idea is that you need to understand how the company operates and what are the factors which drives it, and what are the risks that could bring you as an investor in the situation where the company will default. So to do this, you need to look into the industry first, then you need to look into the business profile of the company, its operational profile, and its financial profile. So I would suggest that you stick to this 4 C's framework with the most focus on the capacity. When speaking about the company's industry, I do not expect you to be the specialist in each particular industry, but still I would ask you to look into briefly, I would say 1, 2, maximum 2 slides on the industry, saying about the key industry characteristics and trends, and whether it is cyclical or not. I would also ask you to give me a company business description, its competitive position, and its operating history. I would say that 1, 2, 3 slides on this will be quite enough. Then switch to financial part. Do a company's financial statement analysis. Calculate the ratios which you consider effective to be attributable to this particular company. Again, I would stick with the ratios which we discussed today. Also, look into the company's financials. Try to, I would say that 3 years history will be enough. Look into the, company's revenues, its margins, its cash flows. Please pay attention to the quality of company's assets, which we discussed today, the percentage of goodwill, how the capex will coincide with the company depreciation. Look into the proportion of secured and unsecured debt. Try again to estimate what are the possible trends in the future revenues, margins of the company, and cash flows. Actually, this is crucial, but I understand that you have a lot of different tasks, and again, I will not require a financial model, but if you can, this will be significantly plus. Okay, then we discussed already the calculations of key credit ratios. Think about future revenues, margins, and cash flows. Also, we discussed this. Crucial thing, even if your company will be the investment grade company, think about the sources and uses of liquidity. Will your estimate of future margins and thus cash flows be enough to company to service its interest payments and do scheduled payments on principal? You can open the company financial statements. You can open the company financial presentations. All companies are quite transparent now, and you will have enough information on the majority of the companies which you will receive. Please look and try to understand, will the company be able to to redeem the scheduled debt, or you will expect that the company will rely on refinancing, and then you will need to understand whether the company had any issues refinancing it. So the refinancing, debt principal payments is fine, it's nice, and well, nothing requires the company to just to redeem its debt and to not to attract new. So you need to understand whether the company have an ability to redeem its debt, so whether its cash flows will be enough or at least close to enough. But still, you also need to understand how the company refinanced its debt in former periods. I believe that in majority of the cases, you will find out that the company just attracted the new debt and paid the old one, and this is, well, a normal exercise. It's just what the company should do. The company should not fully eliminate the debt from its capital structure. You perfectly know, I believe, that the debt is much cheaper than the equity capital, so why not rely on that? That's fine, but you need to examine this and be able that the company will not have any problems with the refinancing. Also, I would ask you to do the peer analysis, based on the credit ratios. Look into the closest peers, the Russian peers. Please take the Russian peers, because we will operate mostly in the Russian Eurobond market. Look into how the companies possessed among peers in terms of its credit ratios. Compare the company in terms of net debt to EBITDA, for example, in its EBITDA margin and debt to capital ratios. Also compare them in terms of ratings. And then I would expect you also to build a yield map. We will discuss what is a yield map in the next class. This is actually how the company outstanding Eurobonds trade on different tenors. And I will ask you to compare it with the peers. Again, we will discuss it more details next time. And I would like you to say a few words whether you consider the difference in yields on the same tenors of different issuers, of peer group of issuers. Is it fair or not? Do you consider your company to be yielding quite an interesting yield or not? I will provide you with all the data, so with all the Eurobond universe which you will need, including the Eurobonds of the peers, including the tenors and the yields. So all this information I will provide you with. So don't worry about the source of the data. So, and finally, speak about the covenant package, just what we discussed 10 minutes before. I will also provide you with the Eurobond prospectuses. Go please to the terms and conditions, find the covenant section, and do the brief overview of the company's covenant package of not all of its debt, but just of the debt which I will provide with bond prospectus of particular bond issue. So, and finally, speak about the risk factors which you see for the company. So, to summarize, you are expected to receive a credit report, which will be in the form of presentation, 1 to 2 slides about the company's industry, 1 to 3 slides about the company's business profile and its operating history and how operating results. A few slides on its financial performance, how key financial metrics look like, how the company is positioned, versus its peers. Speak about difference in credit ratings and key credit ratios. I forget, one step back. When we speak about financial analysis, make a slide on the company's source and uses of liquidity. I would assume that you put here some kind of a debt redemption schedule, which you will find in the company's financial statements or in financial presentations, and speak about future sources and uses of liquidity. So then peer positioning, how your company is positioned in terms of credit ratings and credit ratios versus your peers. Then yield map and how the company's Eurobonds are positioned against its peers. covenant package, and risk section. So I believe overall 10 slides approximately will be enough. Do not do quite big presentations, but please try to address the topics which you see in these slides. So where to find the data? First of all, your key source of information will be the company website, where you will be able to find company's financial statements, management discussions and analysis, IR presentations, and press releases. They are all available on the company website. I will also provide you with the Eurobond prospectus, which has a lot of information regarding the business description. So they are sometimes might be out of date, but still, to understand better how the company operates, please take some time and examine this. Also, please search for recent headlines in business media. I understand that you might not have a Bloomberg access, but probably you have it through Harris School of Economics account. No? Okay, you might well skip Bloomberg, but again, try at least Googling it in Yandex or in Google or in Kommersant, in Vedomosti. I want you to provide credit analysis backed on the most recent with up-to-date analysis. For example, a lot of things are happening around the companies right now. For example, Rusal is spinning off assets. Petropavlovsk has a management conflict, etc., etc. So please do not provide me with analysis which is outdated, which do not incorporate the latest trends. You can all find this in the internet. You will not need any additional source of information. And finally, you can register on credit rating agencies' websites, S&P, Moody's, and Fitch. You will not have an access to full credit reports, but you will have an access to press releases following each rating overview with a very full description of the company's credit case, highlighting credit strength and credit risks. I assume that this is a very valuable information for you, and you're actually expected to do something similar to this, but well, more thorough, but still. There will be a lot of useful information for you. Again, just register. The access is free. You will not be able to receive full credit reports because they are not free. You need to pay for them, but you will be able to receive enough information to your work. So I believe that is it. Again, please provide me, those who still did not provide, please provide me with the group splits till the close of business today. Oh, sorry, tomorrow. If you will not do this, I will split the rest of you who was unable to split them themselves. I will split it on my own and will attribute you different company names which you're expected to provide research on, and will provide you with all the required information for you to be able to start working. Let's see on the schedule. So you will have almost 3 weeks to do this, 2.5 weeks. I believe this is more than enough. I understand that you have another tasks, but again, I believe this is more than enough. I will also think about the deadlines on the first iteration draft and the pre-final draft. Please, again, as I started with today's class, the first draft, you will not have time to well do some charts, some deep understanding of the company, but please examine the company and at least understand the story which you will try to tell me. Just give me like some kind of skillet presentation, but it should be it should demonstrate that you understand what we're talking about. And pre-final drafts, we will, I believe, we will overview them a few days before your presentations, so that I can give you comments and you have enough time to incorporate them. So that's all on my side. A good question from Yegor Kolesnikov. How much do usually companies pay to rating companies to get rating? I mean, Fitch, Moody's, and S&P. Good question. I believe this is a matter of commercial discussions between rating agencies and companies. Is it millions, hundreds of millions, and even billions? Definitely not. I would say it's approximately $1,000 and maybe $1,002 for initial rating, and then $100,000 for initial rating, and probably then $100,000 for, well, the periodical overview of the rating. Company also usually pays some fees on the debt which they issue, because if the rating agencies rate this particular debt, sometimes they are required to do so, sometimes they just have an opportunity to do so. So the company pays some percentage of the bond or bank loan size if this debt is also rated. But overall, for the corporate rating, I would say, well, from $50,000 to $100,000, but at least this is the Russian practice.
Thank you. I would like to ask one question more. Just maybe philosophy question. Why, for example, these big three rating companies may give rating to Gazprom, for example, 2B, yes, and Russian rating companies could give rating about AAA, even AAA. Why do we see such big difference? What is the reason for it?
The reason is very simple, because they use different scales. The Russian rating agencies, they use the local scale, and they align their ratings versus the sovereign. They consider the sovereign the risk-free. So the sovereign will receive the highest rating, and they will rate all the corporates given the local scale of ratings under this assumption and under the assessment. Opposite to this, the international rating agencies, they will use the international scales, and they will first rate sovereign again, given how the sovereign looks like, not on the local scale, but on the international scale. And they will adjust the corporate ratings again against the sovereign ratings. Actually, our Russian rating agencies, if I'm not mistaken, either Akro or maybe Expertra, they started also publishing external scales, and they can now also rate corporates not on the local scale but also on the external scale.
Yeah, clear. Thank you.
Thanks. So if no more questions, that's all for today. Again,
one more question about ratings. As far as I know, we have two approaches to ratings. It is through the cycle and point in time.
Say again?
Through the cycle and point in time.
Yes, that's right. That's true.
So we have three main rating providers. These are Moody's,
S&P and Fitch.
S&P, yes. Which of them are through the cycle and which point in time?
No, they all have different rating methodologies, and they have different rating approaches. I would say, as for me, it's quite a huge topic for discussion. For me, the S&P's methodology is the most efficient and it's the most thorough. But all of them rate the companies through the cycle. And a good example is previous year, because the previous year, what happened? We saw a significant decrease in everything. A significant decrease in spending, in the significant decrease in revenues and margins of the majority of the companies, because people were sitting down in their homes and didn't spend their money, and spending money not only on iPhones and televisions, but also on the flats, meaning that the construction sector was down, the metal sector was down, everything was down. But the idea, but still, the majority of the companies, for example, even Russian companies, they did not lose their rating levels, just because the rating agencies said that, guys, we rate the company through the cycle. And usually they take different time periods, but usually they take the last year, they take 2 years back, and they take, the forecast for next 2 to 3 years. So they use the company's financial model, they build their own financial model, they do some adjustments, which should be quite conservative versus the company's own provided financial model, and they project the company's financials on the next 2-3 years. Some of them calculate the average ratios on this 5-year horizon, 2 years back, well, 2-3 years back, 2-3 years of the forecasted revenues. Some of them might put different weights for results of previous periods or for future periods. For example, S&P can use different methodologies and different weights, and sometimes quite personal view of the rating analyst. That's it.
Where can we find rating systems? Where can we find point-in-time rating systems?
Where can you find what?
Point-in-time ratings. And
No, the ratings are point in time. Well, you have a rating, which is, for example, BBB. This is the current rating. But to assess the company, the rating agency calculates not only the current financials, but the rating, through the cycle rating means that they calculated the old trends, the future trends, and the current trends. So this is how you receive the through the cycle process.
Yes, but I mean rating systems where a company, for example, can lose rating during crisis, but the probability of default, which was estimated by rating, for example, is quite stable in time.
Probability of default is actually you can align each rating level to the probability of default. This is actually what it shows. So your company might receive a rating upgrade or downgrade driven by a lot of number of factors. They can be quantitative, they can be qualitative. It depends. You can open, if you register on the rating agency's websites, you will be able to see what are the factors which the rating agency might use either to downgrade the rating or either to upgrade. So the financial analysis is only one factor. But again, in financial analysis, the rating agencies will use the through the cycle approach, meaning that they will do some average by different algorithms. They can do it differently, but they will do they will calculate the ratios and the indicators on some kind of average base. I didn't answer your question. Okay, guys, this is all. Please split into groups. See you next time.